Shah as well joining in on the show. Rahul, so much to talk about given that we're in the thick of the earnings season right now. Let's begin with your views then on Ultratech Cement. Given the fact that you did see the operating performance come a little bit better than peers, how have you read into the overall volume growth, the fact that you had the EBITDA missing the consensus, and how would you stack it up compared to some of the other cement heavyweights?
Hi, good morning. I think obviously Ultratech being the leader, I think the all eyes on the entire cement pack is on the Ultratech. The numbers by and large are, I think, in line with what we were estimating in terms of top lines or in terms of the margins. So I think the numbers were pretty in line. And commentary was also, I think, in line what we were expecting about it. So I think no complaints. I think the overall, I think the entire cement as a sector has been re-rated. I think post the input commodity also has fallen substantially. The petcoke prices, which were used to be a volatile in last quarter, has come into better this time. So my sense is, I think the numbers were in line, and I think one should look at buying Ultratech cement as in their portfolio. It looks like that would be at least another 20% upside for an investor in next 6 months or so.
Rahul, so that's the word coming in as far as the entire cement pack is concerned, but also wanted to understand what's your take regarding the Midcap IT earnings. Now, overnight we got the earnings from Persistent System, and yes, after that 9% plus constant currency growth rate that we have seen over the last 5 quarters, it has slowed down considerably to 5.1%, but it's still ahead of street expectation as the constant currency growth is 6.6%, and the biggest surprise this quarter was the margin resilience as well. Street was working with a decline, but they have delivered a 30 basis point improvement as well. Yesterday, we saw in market hours the reaction coming in for KPIT as well. It was a knee-jerk reaction. The company has actually increased the guidance, plus the performance was quite solid, but at least the stock was coming under pressure. How are you looking at the entire mid-cap space? Is it just the valuations that continue to be punchy, and that's why they need to over-deliver to compensate that, you think?
I think the biggest thing to look at in the IT company is, I think, the mood of the investors. So I think the investors have been sellers consistently in last 3-4 months. If you look at it, I think we've seen in the entire IT major pack has been has been just been a complete seller. So be it starting from the large cap names or the mid cap names. So obviously mid cap follows the large cap. So I think this entire the flows perspective, I think IT is going to remain underweight for some time. I think third quarter usually remains a little bit weaker for the IT companies. So I think I don't think so any momentum pick in next at least 3-4 months in an IT perspective. But yes, considering the valuation is only one factor. So if you have a view for next year plus or so, I think a lot of companies, I think in a mid cap as well as a large cap IT companies remain very good in terms of this. So it is like a perspective in last October, November, when we saw the investors just selling off the financials, and we've seen that when the numbers started coming up, the financials have been in the front seat right now. Same thing, I think, in next 6 months or so, I think I think IT will also start performing. That is what looks like, because you can't see any from the valuation perspective here. I think still will getting eroded from. Yes, if you ask me 6-8 months back, when yes, most of the IT companies were trading at very expensive valuation. But now I think they are very reasonable. So my sense is, I think mid cap, large cap, all entire IT services companies, I think one should look at it for an investment perspective.
Okay, that's Rahul Shah's views, and it comes at IT, far more expensive at the start of the year, looking better valued and priced in at the current juncture, so it can be reconsidered. I'm going to now talk about stock that is up about 59% year to date, more than 30% the last 6 months. It was the most memed stock of 2021, and it's coming out with its earnings today. Yes, I'm talking about ITC, which slowly has been climbing up and is now trying to take out $350 a share. The earnings will be out later today. Rahul Shah, what's your view when it comes to ITC?
I think the entire IT pack, ITC, if you look at it, I think all the businesses have been firing up. Be it FMCG business, where we'll see the margin expansion as well as the volume growth. Second, I think hotel businesses, I think we've seen that. I think most of the hotel companies have done very well, and I think we've been hearing that numbers should be good for them. right? Thirdly, I think cigarette businesses have been, at the top of their game since last few years. So my sense is on the front, ITC should look good. Valuations are reasonable vis-a-vis still other, if I compare the FMCG companies. So my sense is I think that one should have in their portfolio considering as an allocation in a consumer pack if you don't have it.
All right. Speaking of ITC, they're going to report their numbers today. The volume growth is expected to remain steady, but inflation pressure could hurt the margins.
Since we're talking about the retail space, let's talk about a couple of earnings also that came overnight. Shoppers Stop, wherein the revenue jumped up by 58% on a year-on-year basis, so that was quite a solid set. For Metro as well, the revenue is up 47% year. Yes, the gross margins have declined a tad bit, 240 basis point, but the street will also be reacting to the acquisition that the company has made. So that's something to watch out for. So Shoppers Stop perhaps hold up in the green. Metro brands will be a tad bit of mix, and Havells was a complete washout given the EBITDA margin performance as well. Rahul, wanted your take regarding a couple of these discretionary spend names, Havells, Shoppers Stop, Metro brands.
I think post-COVID, if you look at it, I think most of the discretionary consumption play has done very well, and I've been seeing the commentary also from most of the viewers very positive on the entire sector. But I think we need to be selective in terms of the earnings perspective in that. So a couple of them are trading at obviously at a very high valuations. So I don't think so. There could be a good upside over there. So just to name it, I think Trent is expensive, and I think the stock has obviously delivered quite well in last few months. So I don't think so and will major any money to be made on in near term in that. But yes, if you look at the entire footwear industries, where we've been very positive on entire space. So be it be a Metro, be it be Campus. So I think both stocks looks quite interesting to it. Thirdly, I think in this space, I think what we've been very positive also on the Vedant fashion. Obviously, in a near term, the stock looks expensive, but the kind of growth what we are seeing in next 2 to 3 years from this perspective, and virtually a monopoly kind of a business in organized markets. So I think that also looks very interesting to it. Havels, if you talk about, I think yes, the numbers were pretty, at least a little bit weaker in terms of what we were also estimating. The margins were shrink. So I think near term the stock might remain in a pressure, and I think one should avoid in near term at least till the time the entire maybe a quarter or so, and then we can have a look at it on post that.
Rahul, BEL is also going to be in the spotlight today. They've signed that MOU with Triton Electric Vehicle. This is for manufacturing hydrogen fuels at an estimated value of about 8,060 crore rupees. Now, given that BEL has traded as at a steep discount compared to some of the other large cap industrial companies, how are you looking at this news bit? And of course, a lot of the measures that have been taken by the government with respect to boosting the defense sector. Where does your preference lie here?
I think you rightly said it. I think most of the defense names have done quite well in last 6 months. Post, I think the Ukraine crisis, what we've seen, I think the entire defense pack has been re-rated, and I think they've done well. I think India being just for earlier used to be only a domestic player, now it's obviously an export to other countries as well as in our defense equipment. So my sense is I think the entire pack still have some steam left. Obviously, a couple of them have moved up quite sharply. So my preference still would remain in BEL from the looking at the valuations and looking at the size of the company. And I think there is much growth to be and more money to be made for the investors. Looking at the deal which to be signed, obviously it's going to be add revenues to the bottom line. So my sense is I think one should look at BEL in this space. The preference remains the top of the mind in this space.
Nilesh, I wanted to do a technical check with one stock that was higher by nearly 7% in trade yesterday, Container Corporation of India. What would be your approach to this stock today after yesterday's up move?
So this is yet another attempt on that 780 mark for Container Corp. Last time there was some buzz on the disinvestment side of it, something, and the stock went up to 782. Again, retested 680 levels. Yesterday was a move without any announcement, so that's the good part of it. And 750, 780 has been a resistance. Last year, August also, it topped out around 750, as well as in May of last year. And if we go back all the way to pre-COVID, also in 2015 to 2019, 600 was a resistance. So the stock has not done much over the last 7 years. Technically, yesterday's move is a very strong move, given that the volumes are also 2x, 3x. So out here, if it can sustain 780, it makes a move towards the 900 also in the short term. And an intraday dip today, if it comes towards 750, that would be an entry point with a stop loss at 730.
Concor, quite a mover in yesterday's trading session, but lots of special programming. And as we gear up for the new year and welcoming new beginnings, we've got a special interaction, none other than the broking industry's one of the top leaders of change, and that's Dinesh Thakkar, MD and chairman of Angel One. He's been instrumental in changing the legacy broking firm's business model to a fintech company, and not just that, is also known for his passion for performance cars. So here's a sneak peek into that interaction.
Youth, what happens when they come to the market, they have a huge aspiration of making like 30%, 40% return. That is not possible. And when they see that is not possible, they go back to putting money in that FDs, which gives us 4.5%, 5%. So I would say that right balance is to invest regularly, have a CAGR of 17, 18%, it is decent enough. If you get a CAGR of 17, 18% for next 10, 20 years, that means a big, big wealth. They can do an Excel working, they can see what difference it is by putting the money in bank and having a CAGR of 17, 18%. So don't be very kind of an aggressive in terms of investment. You can start your career by being aggressive. At this age, no, they are young. If they lose some amount of 1 year or 2 years saving, that is not a big difference. Bigger money they are going to create at the later stage of their life. This 2 years, they should learn everything.
Super apps to supercars. The personality I have on my show today has got passion for all. Dinesh Thakkar of Angel One is going to discuss his success mantra and what keeps him motivated. Only on ET Now.
Right on then, the space that will be in focus today is the entire financial pack as well. Of course, IndusInd reported a good set of numbers, and to add to that, even EU Small Finance Bank reported a decent set. For IndusInd Bank, we've already seen a solid run-up. It's now around, what, 1218 mark thereabouts. But Rahul, is there more upside available for the likes of IndusInd Bank, or do you have a better preference when it comes to the financial space?
I think IndusInd remains one of my top pick as well. I think after a couple of years they faced post-COVID, I think year and a half, the bank suffered a lot. I think in terms of the numbers what they delivered. But last 2 to 3 quarters and the current quarter itself indicates I think the numbers are pretty decent. The management's guidance also, I think they've been guided about around 18% growth on a year or from here. And so we also expect the numbers were strong in all the front. If I talk about the retail as well as corporate loans, plus the credit cost remains under very well controlled. Going from here, we one of the best stock it was in 3-4 years back, and I think now again the stock has slowly and steadily started building it up. And it's also available at a reasonable valuation. If I talk about in terms of book value, I think 1.8 times FY24, and we also expect that I think there will be a 40% PAT growth between FY22 to 24. So my sense is I think kind of a momentum which we are seeing in the entire financial space, and the credit cycle has turned. So I think in all the front, I think IndusInd remains one of our preferred bets in the private sector banks. So I think considering the valuations, considering the growth, and considering all the sectors which they have been into, so they have been doing very well. So my sense is one should definitely buy IndusInd Bank post these numbers.
So Rahul Shah, IndusInd Bank or the bank that's going to come out with its numbers later today, Axis Bank, which one do you prefer more?
I think Indus definitely yes. Vis-a-vis Axis, if I look at it, the stock has also I think been here only in if I look at in last 2 years performance. So I think the numbers, last quarter numbers for Axis were a little bit sluggish within the street what was expecting. The numbers should be good today as the quarterly updates were pretty strong for Axis Bank. So obviously post that quarterly updates, we've seen that the stock moving up 10% from those levels. So my sense is I think Axis also should report a good decent set of numbers. So I think comparing the both, I think obviously I know the numbers for Indus, but obviously Axis also, if what quarterly updates suggest, and if it, then I think Axis also should do well from here.
Rahul, it's been a disappointing quarter for Inox Leisure. The revenues have slumped about 38% sequentially. The company posted a loss of 40 crores The lineup, or in terms of the film pipeline, has been rather disappointing, but the management said that they're optimistic about ad revenues picking up, a very healthy content lineup. They're not even worried about competition from OTT. Have you written off the entire multiplex space, or do you believe that there is still merit to play this space?
I think the money to be made on this segment remains pretty a question mark. So I think we have a better option if I have to play on this segment. So rather, I would go to a media player like Z or such players rather than playing on this at this juncture. So I would rather shift to those companies rather than having Inox in the portfolio at this time.
All right, perhaps a view coming in on some of those broadcasters. That's how you would like to play the entire media space. Moving right on then, let's get in a view on the charts then. And Naresh, what's the outlook on Maruti Suzuki, Bajaj Auto? How have some of these trended off late?
So Maruti has been pretty sideways. The last attempt to break that 9,000 mark failed a couple of times. And on the lower end, 8,500 remains a support. So it's been tightly wound in the range for the last 3-4 months. Overall, the bias is positive, but the momentum is not. So out here, till the time it can't sustain back above the 9,000 mark, there's no sense in taking a long trade here. Also, the previous highs back in 2017-18 was at 10,000 odd levels. So there are a bunch of resistances on the upside from here on. So for now, it is still an avoid. If it breaks below 8,500, that is where the downside just starts coming in. Bajaj Auto, very similar. The stock tried to make breakout moves over the last 6 to 8 months. Every move failed out after a little bit of a jump up. Now it's trying to again create that base around 3,450 mark. But overall, expecting it to be sideways, 3,450, 3,500 on the downside, 3,800 on the upside. So not really tradable. No trends here in both of these names.
For Maruti Suzuki as well as Bajaj Auto, Maruti Suzuki at least has that tailwind in terms of yen, because now it's hinting towards a mark of 150 versus the dollar, which is what, a 24-year high, a 24-year low rather for the yen. But apart from that, Citi has also written a fresh note on the auto sector, and very interesting pair trade coming in. They recommend an overweight on Eicher Motors and an underweight on TVS Motors. Now this after TVS Motors has already rallied 80% this year, and recently as well we have seen quite a bit of up move on TVS Motors. Now they are saying that perhaps the new models will boost up the sales for Royal Enfield going forward, and they see potential headwinds to TVS Motors volume. At 10%, TVS EBITDA margins could be peaking, they believe. However, for Eicher Motors, they see more upside, at least on the margin terms, and TVS, they believe, is more vulnerable to the onslaught of the two-wheelers in the EV space as well as Royal Enfield as well. Kunal, your take? I thought TVS Motors charts were looking interesting, but for now, Citi is recommending an underweight on TVS Motors.
It's surprising because I think the stock has done reasonably well. It's been one of the best. I think if I'm not wrong, this is more like a dream run for TVS Motors, something which was last seen I think in 2015-16 when the stock had moved up from 300 towards 720 in a matter of I think 10-12 months, and that too more or less like a consecutive manner for TVS Motors. And it's very similar because right now from 600 levels, start of 2022, the stock is now almost at 1120. So that's a return of more than 90% for TVS Motors in that kind of a time span. So it's done reasonably well. The indicators are surprisingly not into any major overbought territory for TVS Motors, at least as of now. So that generally happens when there is a very slow, steady and a measured move which happens into the stock price, and the moves are not exaggerated on major time frames for TVS Motors. So that's generally an indication that the momentum should continue and sustain. I believe now the stock could be heading towards 1200 to 1250 mark from a very short term view, and possibly the stock can scale past about those levels. We can up the base higher for TVS Motors and look out for more higher targets.
Currently trading around 1170 a share. Yesterday higher by more than 3.5% in trade. Yes, that's TVS Motors for all of you. Well, it's that time of the show where we also get you stock-specific ideas from the broader markets. Naresh, I'll come to you first. If you were to look at the broader markets, what are your top picks?
So first is a buy on Aegis Logistics, and we are seeing this momentum across the logistics space, whether it is all cargo, which is not exactly in the same business, but we are seeing this across the board in terms of trends. Now, if you look at Aegis Logistics, yesterday saw almost a 3x to 5x volume jump up, gave a breakout, a triangle breakout about 290. Also, the last time the stock broke out about 220 odd levels with similar or much higher volume, the stock continued a good 20% from there. So out here expecting a move towards 380 in the short to medium term, a stop loss to be kept at 275.
Loss of 275 when we talk about Aegis Logistics. Kunal, what about you? Before first trade, before opening bell, what are your top stock specific ideas from the broader markets?
So I would suggest a buy on granules. Interesting chart over here for granules. The stock forming a classical bullish flag pattern on the daily time frame. The even in the best of the market times as well as in the rough of the market times in last 1 month, the stock has done reasonably well. It's performed in both the market trends for itself, and now at current juncture it's poised at a breakout of this bullish flag pattern. So would suggest a buy on granules. 375 as an immediate target. Stop us at 348.